Sure. The article that we're referring to was entitled Two Acronyms Describe the Market, FOMC and FOMO. We put that on Traders Insight. I'll use the acronym TI on Wednesday the 26th. So I'd appreciate if you can go take a look at that, and then we'll keep going from there. As I mentioned in the article, it just sort of randomly occurred to me while I misheard a friend on a phone conversation. So he said FOMC. I could have thought he said FOMO, and it got my head spinning a little bit because I realized that's it. Those are the two things driving the market right now. There's plenty of other factors, but effectively those are the two main features. And to expand on it a bit more, one I think is a fairly healthy thing to be looking at, although the market may be looking at it in the wrong way, and the other is unhealthy. The healthy one is FOMC. One of the first pieces of advice every trader gets is don't fight the Fed. And FOMC stands for Federal Open Market Committee. The Federal Open Market Committee is the group that sets Fed rates, and all eyes were upon it last week when the FOMC met, and Chairman Powell indicated that essentially that a rate cut was in the cards, and the market really has had the debate now. They've been pricing in, the futures have been pricing in 100% certainty on a rate cut. The question is degree. Let's call it 80-20 split, 80% looking for a 25% cut, 20% looking for a 50 basis point cut. And then the market's pricing in, depending on how you want to look at it, 2 or 3 interest rate cuts going forward. I certainly am not a believer in don't fight the Fed, but I also have to wonder what kind of message the Fed is telling you. If the Fed gives a 25% cut at the next meeting without any real indication that they're going to proceed further, I think the market may be disappointed because the market really has read in so much to the Fed, riding to the rescue of the markets. But I do have to wonder if they either do 50 basis points or really indicate that they're in dire need to cut. You have to wonder what message they're sending you. What are they seeing in the economy that stock prices are not necessarily discounting? The Fed can only do so much. And so while it's very nice to have the Fed at your back, stock prices still are determined by earnings and dividends. The ability to pay dividends, of course, is determined by earnings. So effectively, if the Fed's telling you that the economy stinks, not in so many words, that's not really a great environment. And while it's good to know that the Fed has your back, you really have to be judgmental here as to, are you just buying because of the hopes that the Fed's going to do something more, or the hopes that the Fed's going to be able to, prop up the economy just right? That's a lot of faith to put in one central bank, and they've done a mixed job so far in the Powell administration, and it probably doesn't help that you have a president jawboning about the Fed's independence. So at some point you have to wonder if the president's crying too much for interest rate cuts, does the Fed sort of put the brakes on it just to demonstrate their independence? There's so many moving parts here. But I do always think it's very important. One of the most fundamental things you can do is see at least what the Fed's doing. Don't necessarily, I've often said, while it says don't fight the Fed, nothing says you have to join them. So you may want to look at what they're doing with a bit of skepticism, because I do think that there's a lot more moving parts. I think the market's looking at this somewhat simplistically. Fed's coming, Fed's at your back, let's ride to the rescue. That may not. I think a little critical thinking is required, but it is always crucial to keep the Fed's movement in the forefront of your investment decision making. The other one is FOMO, and FOMO is acronym for fear of missing out. I don't know about when you were kids, but my mother was a big one to say, just because your friends are doing it doesn't mean that you should. And to a certain extent, FOMO, if you're investing based on FOMO, on fear of missing out, which I do think there's a lot of what we see now, you're doing stuff just because your peers are doing it. You don't want to be the guy underperforming. And I think if you're an institutional money manager, it's kind of part of the job because you're paid on relative performance at some level. So I guess you don't want to be the guy holding out and missing the rally if there's one going on. If you're an individual investor, it's really a silly way to invest. there's a lot to be said for momentum trading, and I guess that's probably something we can talk about in a future video or a future article. But if you're doing it because of a real momentum strategy, that's fine. If you're investing just because you think that you're just kind of jealous because other people are making money and you don't want to be the guy who's not, don't do that. That's just silly. That goes back to my mother's adage, just because your friends are doing it doesn't mean that you should. Use those terms accordingly.